Before we begin, a quick and important disclaimer. The following content is provided for educational and entertainment purposes only. It does not constitute professional legal, financial, or tax advice. Every individual situation is unique, and laws regarding asset division and retirement accounts vary significantly by jurisdiction and are subject to change. You should not act or rely on any information in this video without first seeking the advice of a qualified professional in your specific area. Please conduct your own due diligence and consult with a licensed attorney or financial advisor before making any decisions related to divorce or retirement assets. In the high-stakes theater of American litigation, there is no performance more grueling, more expensive, or more emotionally charged than the dissolution of a long-term marriage. While the headlines often focus on the custody battles or the division of the family home, there is a silent, multi-trillion-dollar protagonist waiting in the wings: the 401k. Statistics indicate that for the average American household, the retirement account is often the single largest liquid asset, sometimes even eclipsing the equity in the primary residence. We are talking about a historical trend where nearly half of all marriages in the United States may eventually face the complex machinery of asset division. Imagine spending 30 years in the workforce, sacrificing vacations and luxury purchases to max out your contributions, only to realize that the legal framework governing that money was forged in a series of historical legislative battles you've likely never heard of. This is the Great American Retirement Drama, a saga where a single missing document known as a QDRO can result in the loss of hundreds of thousands of dollars in potential outcomes. Today, we are peeling back the curtain on the evolution of the 401k divorce. We are going to explore the masterclass of historical legal maneuvers that transformed the 401k from a niche corporate perk into a central battleground of U.S. domestic relations. By the end of this deep dive, you will understand the historical precedents, the legislative shifts from the 1970s to the present day, and the precise mechanics of how the law views your private savings as community or marital property. This is about more than just numbers. It is about the history of financial survival in the wake of a split. To understand where we are, we have to look at the prologue of this theater, the pre-1974 era. Before the modern 401k even existed, the American retirement landscape was a wild west of defined benefit pensions. If you worked for a company for 30 years, you got a check until you died. However, if you got divorced, the spouse often walked away with nothing. The law back then frequently viewed the pension as the earned property of the worker alone. This created a massive social crisis, particularly for women who had spent decades managing households, while their husbands built up pension credits. The theater of divorce back then was often a tragedy of total financial abandonment. This led to the first major legislative act in our history, the Employee Retirement Income Security Act of 1974, commonly known as ERISA. You cannot understand 401k divorce without understanding ERISA. This federal law was a response to massive corporate failures, most notably the collapse of the Studebaker-Packard Corporation in 1963, which left thousands of workers without their promised pensions. ERISA was designed to protect employees, but it inadvertently created a massive open loop in divorce law. Because ERISA was a federal law, it preempted or overrode state laws. This meant that even if a state judge in a divorce case ordered a pension to be split, the pension plan administrator could, and often would, refuse, citing federal law that prohibited the alienation of benefits. In the theater of the 1970s courtroom, this was a stalemate that left thousands of divorcing spouses in financial limbo. Then came 1978, the year the 401k was actually born. It wasn't some grand plan to revolutionize retirement. It was a small provision in the Revenue Act of 1978, Section 401k, intended to allow executives a way to defer some of their bonuses. But as companies began to realize they could shift the risk of retirement from the company pensions to the employee 401ks, the popularity of these accounts exploded. By the early 1980s, we saw a massive historical trend of pension shifting. This created a new problem. How do you divide a fluctuating market-based account in a divorce when the laws were written for fixed pensions? The climax of this historical era occurred in 1984 with the Retirement Equity Act, REA. This is the most critical piece of theater in the history of 401k divorce. The REA was a direct response to the unfairness of the ERISA era. It officially created the Qualified Domestic Relations Order, or QDRO. Before 1984, trying to get a piece of a spouse's retirement was like trying to break into a fortress. The REA provided the key. It established that a spouse, former spouse, child, or other dependent could be recognized as having a right to receive all or a portion of the benefits payable with respect to a participant under a retirement plan. Let's look at a case study from this transition period to see the step-by-step impact. Consider a hypothetical couple in 1985. The husband had been an engineer for 15 years, accumulating a significant balance in a new 401k plan. The wife had stayed home to raise 3 children. Under the old ERISA rules, if they divorced, the wife might have had no legal mechanism to force the plan to pay her directly. She would have to rely on the husband to withdraw the money and pay her, which would trigger massive taxes and penalties for him, likely resulting in him refusing or being unable to pay. With the introduction of the QDRO under the REA of 1984, the theater changed. The court could now issue an order that the 401k plan administrator was legally bound to follow. The plan would essentially carve out a piece of the husband's account and move it into a separate account for the wife. This was a historical breakthrough because it allowed the transfer of assets to happen tax-free at the time of the split. The taxes would only be paid when the wife eventually withdrew the money in retirement. This provided a potential outcome where both parties could survive the divorce with their retirement foundations intact. However, the theatrics didn't end with the creation of the QDRO. In fact, it only made the scripts more complicated. In the decades following 1984, the U.S. court system saw an explosion of litigation over what is known as the marital portion. This is where the deep dive into the math begins. If you entered a marriage with $50,000 in your 401k and left it 10 years later with $500,000, how much of that is yours and how much is ours? This is not as simple as subtracting the starting balance from the ending balance. Historically, courts have used 2 main methods to determine the split: the coverture fraction and the tracing method. The coverture fraction is a historical staple of U.S. divorce theater. It is a formula where the numerator is the number of months the party participated in the plan during the marriage, and the denominator is the total number of months the party participated in the plan. This fraction is then multiplied by the total value to find the marital share. The tracing method is far more granular and often used in high-stakes cases involving significant premarital assets. It requires a forensic look at every contribution, every market gain, and every loss to see exactly how the separate property grew compared to the marital property. This is where the drama of the 401k divorce truly hits its peak, as experts are hired to argue over market volatility and contribution timing. As we move through this 10-part masterclass, we will see how these historical trends have evolved into the modern day, where gray divorce among those over age 50, has become a dominant force in the U.S. legal system. The 401k is no longer just a retirement account. It is the most contested piece of property in the American theater of divorce. We will examine the specific pitfalls that can cause a QDRO to be rejected, the historical shifts in how vesting is treated, and why the valuation date chosen by the court can change the outcome by tens of thousands of dollars. This historical journey is the only way to truly understand the complexity of the assets you are working so hard to protect. The valuation date is the specific moment in historical time when the court freezes the clock on your retirement assets. Imagine a couple, Michael and Sarah, living in the United States in the year 2026. They have decided to separate after 14 years of marriage. On the day Michael moves out, January 15th, his 401k account is valued at exactly $600,000. However, the legal system moves slowly. The divorce decree is not finalized until November of 2026. In those 10 intervening months, the stock market experiences a significant surge, and through aggressive investment in a brokerage window within the plan, the account grows to $750,000. This creates a massive point of contention in the theater of the courtroom. Who is entitled to that $150,000 gain? In the historical trends of U.S. domestic relations law, the answer depends entirely on the jurisdiction and the specific interpretation of the valuation date. Some states utilize the date of physical separation, arguing that once the economic partnership has ended, any subsequent gains or losses should belong solely to the account holder. Other states use the date the divorce petition was filed, while a third group uses the actual date of the final trial. This creates a tactical incentive for what we call theatrical stall tactics. If you are the non-account holder and you believe the market is on an upward trajectory, you might historically benefit from delaying the final judgment if your state uses the trial date for valuation. Conversely, if a market correction is looming, the account holder might push for the earliest possible valuation date to lock in a higher marital portion before the balance drops. This brings us to a critical case study involving the historical volatility of the late 2000s. During the 2008 financial crisis, many couples reached settlement agreements in late summer based on 401k balances that existed before the market crash. If the legal document specified that the ex-spouse was to receive a fixed dollar amount, for example, $100,000 from a $200,000 account, and the market then crashed by 40% before the transfer was processed, the account holder was left with only $20,000 while the ex-spouse took their full $100,000. This historical trend led to a massive shift in how QDROs are drafted in 2026. Professionals now almost exclusively use percentages rather than fixed dollar amounts, often including specific language about market gains and losses being applied to the alternate payee's share from the date of valuation until the date of actual distribution. To truly understand the 401k masterclass, we must look at the 5 distinct layers of a retirement account. Most people view their 401k as a single bucket of money, but in the eyes of the law, it is a layered cake. Layer 1 is the premarital balance, which is the amount Michael had in his account the day before he married Sarah. Layer 2 is the marital contribution, which consists of every dollar Michael put in from his paycheck during the 14 years of marriage. Layer 3 is the employer match, which is often mistakenly viewed as a gift, but is legally considered deferred compensation earned during the marriage. Layer 4 is the investment growth on the premarital portion, and Layer 5 is the investment growth on the marital portion. The complexity intensifies when we examine the employer match trap. Imagine Michael works for a large tech firm in 2026 that offers a 5-year graded vesting schedule. He has been at the company for 3 years. His account statement shows $50,000 in employer matching contributions. However, according to the plan rules, he only actually owns 60% of that money. If he stays 2 more years, he will own 100%. In a divorce, does Sarah get a share of the unvested 40%? Historically, courts have seen potential outcomes where the unvested portion is treated as a marital asset because the labor that earned that match was performed during the marriage. The court might issue a deferred distribution order, meaning Sarah will only receive her share of that match if and when Michael actually stays long enough for it to vest. This adds a layer of long-term financial entanglement that many people are unprepared for. Another high-stakes element is the 401k loan complication. In our 2026 scenario, let us imagine that 2 years ago, Michael and Sarah took a $50,000 loan from the 401k to fund a major home renovation. At the time of the divorce, $30,000 of that loan is still outstanding. This creates a fascinating legal paradox. The 401k balance appears lower because of the outstanding loan, but the loan itself is an asset of the 401k and a debt of the marriage. If the money was used for a marital purpose like the house, both parties are typically responsible for the debt. However, 401k loans are repaid through automatic payroll deductions from Michael's check. If the divorce is finalized but the loan remains, Michael is essentially using his separate, post-divorce income to pay back a marital debt that increases the value of an account that Sarah may have already received a portion of. This requires precise step-by-step drafting in the settlement to ensure Michael is credited for these post-divorce repayments, or that the loan is offset by other marital assets. We must also consider the latent tax liability, which is perhaps the most misunderstood aspect of the 401k theater. In the United States, a 401k is a tax-deferred vehicle. This means the $600,000 in Michael's account is not actually $600,000 in spending power. When that money is eventually withdrawn, it will be taxed as ordinary income. If Sarah agrees to take $300,000 from the 401k, while Michael takes $300,000 in equity from the sale of their primary residence, Sarah is receiving a significantly worse deal. Under U.S. tax history, the first $250,000 of gain on a primary home sale for an individual is often tax-free, whereas Sarah's $300,000 will be subject to federal and state income taxes, potentially leaving her with only $210,000 after the IRS takes its share. In 2026, sophisticated forensic accountants use tax-affected valuations to ensure that a 50-50 split is actually equitable in terms of real-world purchasing power. Then there is the administrative gauntlet known as the summary plan description. Every 401k plan in the U.S. is governed by its own unique set of internal rules. Some plans allow for an immediate lump sum distribution to an ex-spouse via a QDRO. This allows Sarah to take her share, roll it into her own individual retirement account, and manage it independently. However, other plans are far more restrictive. They might follow a historical trend of deferred distribution, where Sarah is legally entitled to the money, but cannot touch it until Michael reaches age 59 and a half or actually retires from the company. Imagine the scenario where Sarah is counting on that money to start a new life in 2026, only to find out she is tied to her ex-husband's career path for the next 2 decades. This is why the discovery phase of a 401k divorce must involve a deep dive into the specific plan documents before any settlement is signed. As we look closer at the actual mechanics of the transfer, we encounter the Section 72T exception. This is a rare historical loophole in the tax code that specifically applies to divorce. Normally, if you withdraw money from a 401k before age 59 and a half, you pay a 10% early withdrawal penalty. However, when money is distributed to an alternate payee via QDRO, the 10% penalty is often waived. This allows the receiving spouse to take a cash distribution to cover immediate divorce-related expenses without the standard penalty, though they still owe the ordinary income tax. Understanding these specific tax historical trends is the difference between financial stability and a sudden unexpected tax bill. But what happens when the 401k plan administrator rejects the QDRO? What if the company Michael works for is sold, or goes through a merger during the middle of the divorce proceedings? The transition of plan records during a corporate merger can freeze accounts for months, leaving both parties in a state of financial paralysis. And even more dangerously, what is the single most common clerical error that causes the IRS to invalidate a 401k rollover, resulting in a total loss of tax-deferred status for the entire account balance? We are moving into the most volatile part of the process, where the intersection of corporate bureaucracy and tax law creates a minefield for the unwary. The clerical error that often triggers an IRS invalidation usually begins at the very moment a check is cut. In the historical trends of U.S. retirement law, there is a massive distinction between a direct rollover and an indirect rollover. When a Qualified Domestic Relations Order, or QDRO, is finalized in 2026, the plan administrator for the 401k is instructed to move a specific portion of the assets to the alternate payee, which is the legal term for the ex-spouse. If that ex-spouse requests the funds be sent to them directly with the intent of depositing them into their own IRA later, they fall into the 60-day rule trap. Under Internal Revenue Code Section 402(c), if the distribution is made out to the individual rather than a qualified retirement institution, the plan is legally mandated to withhold exactly 20% for federal income taxes. Imagine if an ex-spouse, let us call her Maria, is awarded $200,000 from her former husband's 401k in 2026. If the check is written to Maria personally, the plan administrator sends her $160,000 and sends $40,000 to the IRS as a tax withholding. To avoid taxes and penalties on that $200,000, Maria must deposit the full $200,000 into an IRA within 60 days. This means she must find $40,000 of her own cash to make up for the amount the IRS took, with the hope of getting that money back as a tax refund a year later. If she cannot find that $40,000, the IRS considers that portion a premature distribution, and she could face ordinary income tax plus a 10% early withdrawal penalty if she is under age 59 and a half. This is a potential outcome that has decimated the liquid savings of thousands of Americans who did not understand the step-by-step mechanics of the transfer. This administrative theater becomes even more complex when we look at the role of the plan administrator as the ultimate gatekeeper. In the United States, a judge can sign a divorce decree and even a QDRO, but that does not mean the 401k money moves. The plan administrator, often a third-party corporate entity, has the federal authority under ERISA to reject a court order if it does not strictly adhere to the plan's specific internal guidelines. Historically, we see rejection rates as high as 40% on first-time QDRO submissions. The reasons are often pedantic but legally significant. For instance, if the QDRO refers to the 401k as the profit-sharing plan, but the legal name in the company's filings is the Employee Savings and Investment Plan, the administrator will reject the order. Let us examine a case study from the current year, 2026, involving a character named Alex. Alex is an executive at a large logistics firm that is currently undergoing a merger with a global conglomerate. Alex is in the middle of a divorce. His 401k is a primary asset. During the merger, the company changes its plan provider from one financial institution to another. This creates a blackout period where no transactions can occur. If Alex's divorce settlement is signed during this window, the QDRO might be drafted using the old plan's information. By the time it reaches the administrator, the old plan no longer exists. The resulting legal fees to redraft the documents and the potential loss of market gains during the delay can be astronomical. Alex's situation highlights a historical trend where corporate restructuring acts as an unscripted plot twist in the drama of asset division. The separate interest versus shared interest approach is another deep dive topic that determines the long-term survival of these assets. In most 401k divorces, the court prefers a separate interest QDR. This effectively bisects the account. The ex-spouse, Maria, receives her own account within the plan or rolls it over to an IRA, and from that moment on, her financial destiny is decoupled from Alex's. She can choose her own investments and her own beneficiaries. However, in some older plans or specific defined benefit scenarios that look like 401ks, a shared interest QDRO is used. In this scenario, Maria only gets a portion of each payment as Alex receives it. If Alex decides to keep working until he is 75, Maria may not see a dime until then. This historical method is increasingly rare for 401ks, but remains a trap for those dealing with legacy corporate plans. There is also the silent killer of retirement assets, the gap period survivor benefit. This is the period between the day the divorce is finalized and the day the QDRO is actually qualified by the plan administrator. This process can take months. If Alex were to pass away during this window, his 401k would typically be paid out to his named beneficiary. If he had already updated his beneficiary to his new partner or a sibling, or if the plan default rules kick in, Maria could be left with absolutely nothing, despite having a signed divorce decree from a judge. In the theater of U.S. law, the federal rules of ERISA almost always trump state divorce laws. This is why experienced legal professionals in 2026 use joinder actions or preliminary injunctions to freeze the account and name the ex-spouse as a temporary, surviving spouse, until the QDRO is fully processed. Step by step, the process of securing these assets requires a model QDRO review. Most large U.S. employers provide a template or a model QDRO. While this seems helpful, it is often a one-sided script. The model QDRO is designed to protect the employer from liability, not necessarily to ensure the most equitable distribution for the spouse. For example, many model QDROs default to a valuation date of the date of distribution, which, as we discussed, can be highly unfavorable in a volatile 2026 market. If the account loses 15% of its value while the lawyers are arguing, a spouse expecting a fixed sum might find their portion significantly reduced. We must also analyze the historical trend of lost participants. In the mobile workforce of 2026, it is common for a person to have 4 or 5 different 401ks from previous employers. During a divorce, if these accounts are not properly disclosed or tracked, they become phantom assets. A deep dive investigation into a spouse's Social Security earnings record is often the only way to uncover these hidden stages of wealth. If an account is found years after the divorce, a post-judgment QDRO must be filed, which is a specialized piece of legal theater that involves reopening a closed case, often at great expense. As we move forward, we have to address the most controversial part of the 401k theater, the double-dipping debate. This occurs when a 401k is divided as an asset during the divorce, but then one spouse later tries to claim the other's remaining portion as income for the purpose of calculating alimony or child support. Can the same dollar be an asset on Monday and income on Tuesday? The historical precedents in U.S. courts are split, and the potential outcomes in 2026 are shifting toward a more rigid anti-double-dipping stance. But the exceptions are numerous. But what happens when a 401k isn't just a 401k? What if it contains company stock that has its own unique tax rules known as net unrealized appreciation? And more importantly, how do you handle a situation where a spouse has intentionally drained their 401k through emergency loans just weeks before filing for divorce? We are about to enter the world of financial forensics and the specialized tax strategies that can save or cost you a fortune in the blink of an eye. When a spouse begins to drain a 401k through emergency loans or massive withdrawals just weeks before a divorce filing, they are entering a legal minefield known as the dissipation of marital assets. Imagine a character named James in the year 2026. James has been a senior project manager for 20 years and has amassed $800,000 in his 401k. Sensing that his marriage to Linda is failing, James decides to take the maximum allowable loan of $50,000 from his account. He tells himself he is just securing some liquidity for the upcoming transition, But instead of using it for marital expenses, he spends it on a lavish solo vacation and a down payment on a luxury vehicle that he titles in his own name. In the historical trends of U.S. family law, this is a classic case of economic misconduct. When Linda's legal team begins the discovery process, the first thing they look for is a sudden dip in account balances. In 2026, forensic accountants use sophisticated software to track the timeline of every loan and withdrawal against the date of the breakdown of the marriage. If the court determines that James used marital funds for a non-marital purpose at a time when the marriage was undergoing an irreconcilable breakdown, they will utilize the add-back remedy. This means the court will treat that $50,000 as if it still exists in the 401k. When it comes time to divide the remaining $750,000, the court might award Linda $400,000 while James is left with $350,000, effectively making James pay back his own loan using his share of the assets. This potential outcome serves as a stark warning. The theater of the courtroom has a long memory for suspicious financial timing. However, the drama intensifies when we look at a highly specialized and often overlooked tax strategy known as net unrealized appreciation, or NUA. This is a masterclass level concept that can save a divorcing spouse tens of thousands of dollars in taxes if handled correctly during a 401k division. NUA applies specifically to 401k plans that hold actual shares of the employer's company stock. Historically, many large American corporations like energy giants or legacy tech firms have offered company stock as part of their matching programs. Let us look at the step-by-step mechanics of NUA in a 2026 divorce scenario. Imagine Linda has $500,000 worth of company stock in her 401k. The cost basis, the price at which the stock was originally purchased over 20 years, is only $50,000. The remaining $450,000 is the net unrealized appreciation. If Linda and James simply divide the 401k using a standard QDRO that liquidates the stock and rolls it into an IRA, they are making a massive historical mistake. Why? Because once that money is in an IRA, every single dollar withdrawn in the future will be taxed at ordinary income tax rates, which in 2026 could be as high as 37% for high earners. But if the QDRO is drafted with precision, Linda can use the NUA strategy. She can move the company stock shares directly into a taxable brokerage account. At the time of the transfer, she only pays ordinary income tax on the $50,000 cost basis. The $450,000 of growth is not taxed at that moment. Instead, when she eventually sells the stock, that growth is taxed at the long-term capital gains rate, which is typically much lower, often 15 or 20%. In the theater of financial survival, the difference between a 37% tax hit and a 20% tax hit on nearly $500,000 is the difference between a comfortable retirement and a struggling one. This is why a deep dive analysis of the 401k's internal holdings is mandatory. You are not just dividing money, you are dividing different types of tax liabilities. This leads us to the critical role of the forensic accountant in the 2026 landscape. A standard CPA might be able to read a balance sheet, but a forensic accountant in a 401k divorce is looking for the ghost in the machine. They are searching for what we call passive versus active appreciation. If the 401k grew from $200,000 to $600,000 during the marriage, but $300,000 of that growth was simply the market rising while no new contributions were made, an attorney might argue that the growth on the premarital portion should remain separate property. To prove this, the forensic expert must perform a tracing analysis. This involves recreating 20 years of market history, accounting for every dividend reinvestment, every stock split, and every quarterly contribution. In the United States, historical trends show that the burden of proof is on the person claiming the asset is separate property. If James cannot provide the records from 2006 to show his starting balance and how it grew, the court in 2026 may simply default to the marital inception rule, assuming every dollar in that account is marital property subject to a 50-50th split. The loss of records is the most common way that premarital wealth is accidentally gifted to a spouse in a divorce. We also have to consider the timing of the tax trap. In many 2026 divorce negotiations, one spouse will offer to take the house while the other takes the 401k. On paper, a $700,000 house with no mortgage looks equal to a $700,000 401k. But this is a mathematical illusion. The spouse taking the house is receiving an asset that has already been taxed and likely qualifies for a massive capital gains exclusion upon sale. The spouse taking the 401k is receiving a future tax bill. If that spouse needs $50,000 for a new car or a medical emergency in 2027, they have to withdraw about $75,000 from the 401k to have $50,000 left after taxes. In the masterclass of divorce theater, you must always value assets on an after-tax basis to ensure true equity. Another high-stakes scenario involves the early out provision under Internal Revenue Code Section 72T2C. Most people believe you cannot touch 401k money before age 59 and a half without a penalty. But in the context of a divorce, the QDRO provides a one-time escape hatch. The person receiving the money, the alternate payee, can choose to take a cash distribution directly from the 401k provider at the time the QDRO is processed. This distribution is exempt from the 10% early withdrawal penalty. While they still owe the ordinary income tax, this historical trend has allowed thousands of people to fund their post-divorce transition without the crushing weight of IRS penalties. However, this only works if the distribution comes directly from the 401k. If the spouse first rolls the money into an IRA and then tries to withdraw it, the 72T divorce exception vanishes, and the 10% penalty is reinstated. As we look toward the administrative finish line, we encounter the survivor benefit crisis. What happens if James, the account holder, has a change of heart and tries to name his new girlfriend as the beneficiary of the 401k while the divorce is still pending? Or even worse, what if the 401k plan has a default beneficiary clause that automatically wipes out an ex-spouse, right the moment the judge signs the divorce decree? But before the QDRO is finalized, we are entering the most dangerous phase of the process, where a single day of delay in paperwork can lead to a total loss of benefits. And what about the hidden 401ks? The ones from jobs James had 15 years ago that he forgot to mention during discovery. How do we use the U.S. Department of Labor's database to track down every cent that belongs to the marital estate? The hunt for hidden stages is just beginning. The hunt for hidden stages in the theater of 401k divorce begins with the realization that in the modern United States economy, retirement accounts are often scattered across the professional history of a spouse like forgotten props in a massive warehouse. In the year 2026, the average American worker changes jobs approximately every 4 years, leading to a historical trend where an individual might have 3, 4, or even 5 separate 401k accounts by the time they reach mid-career. When a marriage dissolves, the spouse who was not the primary earner often lacks the script needed to identify these accounts. This is where the deep dive into federal databases and forensic discovery becomes the most critical act of the masterclass. Imagine a case study involving a character named David and his wife, Chloe. David has spent the last 20 years working in the tech and logistics sectors. During their 2026 divorce proceedings, David discloses a current 401k valued at $450,000. However, Chloe suspects that David had other accounts from his earlier years at various startups and shipping firms. To find these hidden assets, Chloe's legal team must first turn to the United States Department of Labor and the Employee Benefit Security Administration, or EBSA. The primary tool in this search is the Form 5500 database. Under federal law, almost every employer-sponsored retirement plan in the U.S. is required to file an annual report known as Form 5500. This document is a public record that provides a detailed script of the plan's financial health, its participants, and its administrators. By searching the EBSA database using David's former employers' names, Chloe's team can identify the specific 401k plans that existed during his tenure. Even if a company has merged or changed its name, the historical trends of corporate filings allow a forensic expert to trace the evolution of the plan. This step-by-step process reveals whether a plan was terminated, merged into a new entity, or if it remains active with unclaimed funds. But what if the employer no longer exists? This leads us to the abandoned plan search. In the volatile economic landscape leading up to 2026, many small to mid-sized firms have closed their doors. When a company goes out of business without properly terminating its 401k plan, the assets often sit in a state of limbo. The Department of Labor maintains a specific database for these orphan plans. If David's name is linked to an abandoned plan, Chloe can petition for a qualified domestic relations order against the custodian of those funds, who is often a large financial institution that took over the management of the defunct plan's assets. Another hidden stage in this theater is the Social Security Administration's potential private retirement benefit information. Every year, when the SSA processes earnings records, they receive information from the IRS regarding individuals who have a vested right to a pension or 401k benefit from a former employer. In 2026, a spouse can request a specific SSA 7005 SM form, which acts as a historical record of every private retirement benefit associated with the Social Security number. For Chloe, this document could be the smoking gun, showing that David has a vested interest in a 401k from 2012 that he simply stopped mentioning because he assumed it was too small to notice. In the world of compounding interest, a $10,000 account from 2012 could easily be worth $40,000 or more by 2026. Beyond federal databases, the hunt moves into the granular details of the 1040 tax return and its supporting schedules. A sophisticated deep dive into a 2026 tax return involves looking at Schedule 1 and the entries for IRA deductions or self-employed SEP or simple plans. However, the most overlooked document is the Form 1099-R. Even if a spouse claims they don't have a 401k, a 1099-R from a previous year might show a direct rollover. A direct rollover occurs when funds are moved from one 401k to another or into an IRA. By tracing the 1099-R, Chloe can see exactly where the money went. If David moved $50,000 from an old 401k into a private IRA 3 years ago and never disclosed that IRA, the tax return provides the trail. Step by step, the discovery of hidden assets requires a subpoena of the spouse's W-2 forms over a decade-long period. Many people forget that their W-2 forms contain a specific box, Box 12, which uses codes to identify 401k contributions. Code D specifically refers to elective deferrals to a 401k plan. If David's W-2 from 6 years ago shows a contribution of $18,000 under Code D, but there is no corresponding account in his current disclosure, he must explain where that money is. This historical analysis forces the account holder to account for every dollar that was diverted from the marital income stream into a retirement vehicle. The theater of discovery also includes the Pension Benefit Guaranty Corporation, or PBGC. While the PBGC primarily deals with defined benefit pensions, they also maintain a missing participants database. If a 401k plan was terminated and the administrator could not locate the employee, the funds might have been transferred to the PBGC. Searching this database is a standard move in the 2026 masterclass for finding lost assets that both spouses may have forgotten existed. Once these hidden stages are identified, the challenge shifts to valuation. How do you value a 401k that hasn't been touched in 10 years? You must look for the summary plan description to see if there were any administrative fees or changes in investment options that might have affected the balance. If David claims the account lost value due to poor market performance, Chloe has the right to demand a complete transaction history. In the historical trends of U.S. litigation, the failure to disclose an asset, even if done unintentionally, can lead to severe potential outcomes, including the court awarding the entire hidden asset to the other spouse as a penalty for fraud or non-disclosure. As we conclude this part of the search, we must realize that the 401k is often just the base layer of the retirement theater. In the high-stakes world of executive compensation in 2026, many high earners have what are known as non-qualified deferred compensation plans, or NQDCs. These plans are not governed by the same ERISA rules as a standard 401k, and they do not appear in the Department of Labor databases. They are private contracts between the employer and the employee, often involving millions of dollars in future payments. How do you find an asset that doesn't exist in a public database and is not protected by federal law? And how do you divide a contractual right to money that might not be paid out for another 15 years? We are moving from the public databases into the shadow theater of executive perks and the specialized legal maneuvers required to capture assets that are designed to stay hidden. The hunt for hidden stages in the shadow theater of executive compensation requires moving beyond the simple 401k and into the complex world of non-qualified deferred compensation plans, or NQDCs. In the United States landscape of 2026, these plans represent a significant portion of wealth for high-earning professionals, yet they remain largely invisible to the untrained eye because they do not carry the same federal reporting requirements as a standard 401k. Unlike a 401k, which is a qualified plan protected by the Employee Retirement Income Security Act, an NQDC is essentially an unsecured promise from an employer to pay an employee at a future date. This lack of ERISA protection creates a unique set of historical trends and potential outcomes in the theater of divorce. Imagine a case study involving a character named Sarah, a senior vice president at a major healthcare conglomerate in 2026. Her husband, Mark, is aware of her $1.2 million 401k, which they have already agreed to split using a standard qualified domestic relations order. However, Sarah also participates in a supplemental executive retirement plan, often referred to as a SERP or a shadow 401k. This plan allows her to defer a much larger percentage of her salary and bonuses than the annual IRS limits for a standard 401k allow. In Sarah's case, her SERP holds an additional $2 million. Because this is a non-qualified plan, it does not appear on the standard list of ERISA-governed accounts that a plan administrator would typically disclose during a routine inquiry. The first step in uncovering this shadow asset is a deep dive into the employment contract and the annual executive proxy statements. In 2026, for publicly traded companies in the U.S., the Securities and Exchange Commission requires the disclosure of executive compensation for the highest paid employees in a document known as the DEF 14A, or the proxy statement. A forensic analysis of this document can reveal the existence of these shadow accounts. For Mark's legal team, the discovery process must include a specific request for all non-qualified plan documents, joinder agreements, and benefit statements. Without these, a massive portion of the marital estate remains offstage, hidden by the curtains of corporate privacy. Once an NQDC like Sarah's SERP is identified, the valuation becomes a masterclass in financial forecasting. Unlike a 401k, which has a clear daily balance based on market value, an NQDC is a contractual right. The value is often tied to the future health of the company. In the historical trends of 2026, many of these plans are unfunded, meaning the money is not held in a separate account for Sarah, but is part of the general assets of the corporation. If the company were to face a catastrophic legal judgment or bankruptcy in 2027, Sarah and Mark could both lose everything in that account because they would be treated as general unsecured creditors. This risk of forfeiture must be factored into the divorce settlement. The division of an NQDC cannot be accomplished with a standard QDRO. Since the plan is not governed by ERISA, the plan administrator is not legally required to honor a state court order to split the account into a separate interest for Mark. Instead, the legal maneuver often involves a domestic relations order that acts as a contract between the spouses, or what is known as an if, as, and when arrangement. In this scenario, the court orders that Sarah must pay Mark his share only if, as, and when she actually receives the payments from the company. This keeps the parties entangled for years or even decades after the divorce is finalized, as Mark must wait for Sarah to reach the triggering events specified in her executive contract, such as retirement or separation from service. A critical step-by-step detail in this process involves Section 409A of the Internal Revenue Code. This historical piece of legislation, born out of the corporate scandals of the early 2000s, dictates exactly when and how deferred compensation can be paid. If Sarah and Mark attempt to divide the NQDC in a way that violates Section 409A, for example, by trying to accelerate a payment to Mark before Sarah is eligible, the IRS can impose a 20% excise tax on top of regular income taxes, plus interest penalties. In the theater of 2026, a poorly drafted settlement regarding an NQDC can lead to a potential outcome where more than 60% of the asset is consumed by taxes and penalties. To mitigate this, sophisticated attorneys use a tool known as a rabbi trust. While this sounds like a religious instrument, it is actually a historical trend in U.S. tax law where the employer places the deferred compensation into an irrevocable trust to protect it from a change in corporate heart, though it still remains subject to the claims of the employer's creditors. If Sarah's SERP is held in a rabbi trust, it provides a slightly higher level of security for Mark's future payments, but it does not eliminate the tax complexities. The valuation must also account for the fact that Sarah will be the one paying the income taxes on the entire distribution when it eventually hits her bank account. Therefore, the settlement must include a tax equalization formula to ensure Mark is receiving a fair net amount. Beyond the SERP, we must look at the restricted stock units or RSUs. In the high-stakes corporate world of 2026, RSUs have largely replaced traditional stock options as the preferred method of executive incentive. RSUs are a promise to give the employee shares of company stock once certain vesting conditions are met. The drama here lies in the coverture fraction we discussed earlier, but with a twist. If Sarah was granted 10,000 RSUs 3 years into the marriage, but they do not vest until 2 years after the divorce, how much of that stock belongs to the marriage? The historical precedent often follows the Nelson formula or the DeMazy formula, which looks at the purpose of the grant. Was it a reward for past performance during the marriage, or an incentive for future performance after the divorce? In 2026, courts are increasingly granular, looking at the specific grant letters to determine the intent of the compensation. If the RSUs are deemed to be for future service, Mark might find his share drastically reduced or eliminated entirely. This requires a forensic accountant to map out the vesting schedule against the timeline of the marriage, a process that can take weeks of detailed analysis. The complexity further increases when we consider the dividend equivalent rights often attached to these executive perks. Even if the stock hasn't vested, the executive might be receiving cash payments equal to the dividends paid on those shares. In a deep dive investigation, these payments are often found hidden in the fine print of pay stubs under obscure codes. For Mark, identifying these cash flows is essential because they are marital income that could be used to calculate temporary support or to offset other marital debts. As we reach the end of this deep dive into shadow assets, we have to recognize that the 401k was only the opening act. The real wealth in the 2026 theater of divorce is often found in the non-qualified, restricted, and deferred contracts that never see the light of a standard balance sheet. We have navigated the federal databases, the SEC filings, and the specialized tax codes that govern the executive suite. But there is one final explosive element in this retirement drama that can override every contract and every QDRO we have discussed. What happens when the retirement assets are not held in the United States at all? What occurs when a spouse has utilized a multinational corporate structure to move their 401k equivalent into an offshore jurisdiction beyond the reach of a U.S. judge? The theater is about to go global, and the stakes are shifting from simple litigation to international asset recovery. The moment the theater of asset division crosses international borders, the script changes from a domestic drama into a high-stakes espionage thriller. In the landscape of 2026, the transnational participant is a historical trend fueled by the globalized workforce. Imagine a character named Robert, a senior director for a global financial services firm. During his 20-year marriage to Elena, Robert spent 5 years working in the London office, 3 years in Singapore, and the rest in New York. While his US-based 401k holds $1.2 million, he also possesses a United Kingdom self-invested personal pension known as a SIPP and a Singaporean Central Provident Fund account. To Elena, these are all retirement accounts. To the law, they are governed by entirely different sets of rules, and a US judge has no direct authority over a bank in London or a government board in Singapore. The first obstacle in this international masterclass is the jurisdictional wall. In the United States, we have become accustomed to the power of the Qualified Domestic Relations Order, but ERISA is a federal law of the U.S. and has zero legal standing once you cross the Atlantic or Pacific. If Elena's attorney serves a U.S. QDRO on a British pension provider, the provider will likely ignore it. Historically, the U.S. court's power is in personam, meaning it has power over Robert, not the foreign asset itself. A judge in 2026 can order Robert to sign documents transferring the money, and if he refuses, the judge can hold him in contempt, fine him, or even jail him. However, the judge cannot simply click a button and move the funds. This creates a potential outcome where Robert might decide that the penalty for contempt is cheaper than losing half of a multi-million-dollar foreign pension. To navigate this, we must look at the step-by-step process of international discovery. In 2026, finding these accounts is the first hurdle. Robert might not disclose his Singaporean account, assuming the U.S. courts will never find it. Elena's team must utilize the Hague Convention on the taking of evidence abroad in civil or commercial matters. This involves issuing a letter of request, which is a formal document from the U.S. court to the foreign central authority asking for assistance in obtaining financial records. This process is notoriously slow and expensive. In a historical trend of international litigation, it can take 6 months to a year just to get a response. Robert can use this time to shift assets or argue that the foreign records are protected by local privacy laws, such as the strict banking secrecy historical traditions in certain jurisdictions. Once the accounts are located, the valuation phase becomes a mathematical nightmare. Let us look at the case study of Robert's UK SIPP. In 2026, the British pound fluctuates against the US dollar daily. Which exchange rate does the court use? The rate on the date of separation? The rate on the date of the trial? Furthermore, foreign retirement accounts have different tax structures. Robert's UK pension might allow for a 25% tax-free lump sum withdrawal upon retirement, while the rest is taxed as income. A US 401k does not have this feature. If the court simply treats $1 in London as equal to $1 in New York, the person receiving the US asset might be getting a much lower net value after the IRS takes its share. Forensic accountants in 2026 must perform a cross-border tax-affected valuation, which involves simulating the future tax liabilities in both countries to reach an equitable split. The next act in this drama is the mirror order. Since a QDRO won't work, Elena must hire local counsel in the United Kingdom to initiate a secondary legal action. This involves presenting the U.S. divorce decree to a British court and asking them to issue a pension-sharing order that mirrors the intent of the U.S. judgment. This is a step-by-step procedural gauntlet. The British court must first recognize the U.S. divorce as valid under their laws. If Robert can prove that he wasn't properly served with the U.S. papers according to international standards, he might be able to block the recognition of the entire divorce in the UK, effectively shielding his pension from division. There is also the complication of totalization agreements. The United States has historical agreements with over 30 countries to ensure that workers who split their careers between nations don't pay double Social Security taxes and eventually receive fair benefits. In a 2026 divorce, these agreements must be analyzed to see how they affect the marital portion of a retirement benefit. If Robert's time in Singapore earned him credits that will increase his future U.S. Social Security payments, that increase might be considered a marital asset in certain states. What about the spouse who attempts to offshore their 401k? In the years leading up to 2026, we have seen a rise in high-net-worth individuals liquidating their 401ks, paying the massive taxes and penalties, and moving the remaining cash into asset protection trusts in jurisdictions like the Cook Islands or Nevis. This is the nuclear option of 401k divorce. These jurisdictions have laws specifically designed to ignore foreign court orders. If Robert moves his wealth into a Cook Islands trust, Elena might spend $100,000 in legal fees, only to find that the trustee in the Cook Islands refuses to release a single cent. The only way to combat this historical trend of divorce planning is through the use of mar-eva injunctions, or freezing orders. These are emergency court orders that block a spouse from moving or dissipating any assets anywhere in the world until the divorce is finalized. In 2026, the theater of divorce also has to deal with the accidental American, or the green card holder. If Elena is a foreign national living in the U.S. on a visa, her rights to Robert's 401k are protected by ERISA, but her ability to keep that money in a tax-advantaged state if she moves back to her home country is not. Many U.S. 401k plans will not maintain an account for a non-resident alien. This forces Elena to take a total distribution, which could trigger a 30% mandatory federal withholding tax for non-residents, significantly depleting the asset she fought for years to secure. Step by step, the complexity of the global 401k divorce requires a team that understands the intersection of U.S. domestic relations law, international treaties, and foreign tax codes. We are no longer just looking at a balance sheet, we are looking at a map of the world. Each country represents a different set of obstacles, from the blocking statutes of France that prevent the disclosure of certain financial data, to the Sharia law influences in Middle Eastern jurisdictions that may view the division of a husband's retirement very differently than a court in California. As the curtains close on this international act, we realize that even the most secure fortress of offshore banking has a weakness. But as we return our focus to the United States, a new and even more elusive protagonist has entered the stage. What happens when the retirement savings aren't in a bank at all? What if Robert has bypassed the traditional financial system entirely? We are moving from the world of offshore accounts into the digital frontier. How does a QDRO apply to a retirement account that exists only on a blockchain? And what happens when a spouse claims they lost the private keys to a 401k, equivalent worth millions in decentralized assets? The masterclass is about to enter the realm of the intangible. The realm of the intangible begins with the historical trend of the self-directed 401k and the specialized brokerage window. In the United States landscape of 2026, many high-earning professionals have moved away from the traditional limited menu of mutual funds offered by their employers. Instead, they utilize what is known as a solo 401k or a brokerage link within their corporate plan, allowing them to invest in alternative assets, including decentralized finance protocols and digital currencies. This creates a theatrical challenge for the legal system because, unlike a traditional bank account, these assets do not exist within a centralized institution that responds to a standard subpoena. Imagine a case study involving a character named Marcus, a software architect at a major cloud computing firm in 2026. Throughout his 12-year marriage to Taylor, Marcus diverted a significant portion of his 401k contributions into a self-directed brokerage account. In 2024, He used those funds to acquire a substantial position in a decentralized asset pool. By the time Taylor filed for divorce in 2026, that position had grown from an initial $100,000 to a valuation of nearly $3 million. However, on his financial disclosure forms, Marcus lists the 401k value as only the original $100,000, claiming the rest was lost in a market correction, or that the assets are inaccessible due to a protocol failure. The step-by-step discovery of these intangible assets requires a masterclass in digital forensics. In 2026, forensic accountants no longer just look at paper statements, they look at the blockchain. The first step is to identify the fiat to crypto on-ramp. Taylor's legal team must subpoena the records of Marcus's 401k custodian to find the outbound wire transfer to a digital exchange or a decentralized wallet. Once the transaction hash is identified, the theater shifts to the public ledger. Because every transaction on a public blockchain like Ethereum or Bitcoin is recorded and immutable, the forensic expert can trace the movement of the marital funds from the 401k into the decentralized pool. This leads to the most common defense in the 2026 theater of digital divorce: the lost private key. Marcus might testify under oath that he lost the hardware wallet containing the private keys to the retirement assets, or that a mysterious hacking event wiped out the account just days before the separation. This is known as the boating accident defense in historical crypto circles. However, the potential outcomes for Marcus in 2026 are much grimmer than they were in 2021. The court utilizes a technique called behavioral analysis of the wallet. If the forensic expert can show that the wallet in question has seen outbound activity, such as small transfers to pay for digital services or the movement of tokens to a new address, after the date Marcus claimed the keys were lost, the court will find him in willful contempt. In the historical trends of U.S. litigation, when a spouse is found to have intentionally hidden or destroyed a marital asset, the court can utilize an equitable remedy known as an award of the remaining assets. If the $3 million is truly gone because Marcus refuses to provide the keys, the judge can award Taylor 100% of the tangible marital assets, the family home, the liquid savings, and the remaining traditional 401k balances, to offset the loss of the digital wealth. This is the ultimate checkmate in the theater of the intangible. Marcus might keep his digital keys, but he will lose everything else in the physical world. The execution of a qualified domestic relations order for these assets is another point of high complexity. A standard QDRO is a document sent to a plan administrator like Fidelity or Schwab. But how do you serve a QDRO on a decentralized autonomous organization or a cold storage wallet? In 2026, the solution often involves a court-ordered transfer to a neutral third-party escrow. The court orders Marcus to transfer the specific percentage of the digital assets to a wallet controlled by a receiver. The receiver then liquidates the assets or splits the tokens into a new wallet for Taylor. If Marcus refuses to cooperate with this step-by-step process, the court can issue a writ of body attachment, leading to his incarceration until the digital assets are produced. We must also analyze the tax implications, which are fundamentally different for digital assets compared to traditional 401k holdings. Normally, a QDRO transfer is a tax-neutral event. However, if the digital assets within the 401k have been wrapped or staked in a way that generates recurring rewards, the IRS may view those rewards as current income rather than deferred retirement growth. In 2026, the tax-affected valuation of a digital 401k must account for the potential for a massive capital gains tax hit if the assets are liquidated to satisfy the divorce decree. Taylor might think she is getting $1.5 million, but if the cost basis is near zero and the assets are treated as property rather than currency, she could be facing a historical tax bill that eats up 40% of her award. The theater of the intangible also extends to the valuation date volatility. In a 24-hour global market, a digital asset can lose or gain 20% of its value between the time the judge signs the order in the morning and the time the transfer is executed in the afternoon. In 2026, sophisticated settlement agreements now include a price floor and a price ceiling clause. If the value of the digital asset moves beyond a certain percentage during the transfer period, the number of tokens to be transferred is automatically adjusted to ensure the dollar value intent of the court is maintained. This prevents the account holder from benefiting from a strategic delay during a market dip. Furthermore, we must consider the rise of the metaverse retirement account. As of 2026, some forward-thinking firms allow employees to hold portions of their retirement wealth in digital land or virtual commercial assets. These are not just lines of code, They are income-producing properties within a virtual economy. Dividing a virtual skyscraper in a divorce requires a valuation expert who understands the historical trends of virtual real estate. How do you determine the marital portion of a digital asset that was purchased using a combination of marital funds and post-separation virtual earnings? The coverture fraction must be applied to a world that doesn't follow the laws of physics, but still follows the laws of the Internal Revenue Code. Step by step, the 401k divorce has evolved from a simple division of paper stocks into a high-tech hunt for digital ghosts. The forensic tools of 2026 have made it nearly impossible to hide wealth indefinitely. Yet the complexity of these assets continues to grow. We have seen how a single lost key can change the entire direction of a case, and how the blockchain provides a permanent script of every financial move a spouse makes. But as we master the digital frontier, we must return to a much older and more terrestrial problem. What happens when the retirement asset isn't a digital token or a corporate fund, but a promise made by the government itself? We are moving from the private theater of the 401k into the public theater of the Social Security offset and the high-stakes world of the windfall elimination provision. Most people believe their Social Security is safe from a divorce, but in 2026, the historical interactions between your 401k and your government benefits can lead to a sudden and permanent reduction in your monthly income. The final acts of this drama are about the collision between private savings and public policy. What is the hidden math that allows a judge to take more of your 401k because you are eligible for a government pension? And what is the one document you must file with the Social Security Administration before your divorce is finalized to protect your future survival? We are entering the endgame of the masterclass. The collision between private savings and public policy is the ultimate climax of the retirement masterclass. In the United States, there is a widely held historical misconception that Social Security is a personal asset, much like a 401k or a savings account. However, federal law under the Social Security Act of 1935, specifically Section 407, creates a legal iron curtain. It strictly prohibits state courts from dividing Social Security benefits in a divorce. A judge in 2026 can order the split of a $2 million 401k in seconds, but they cannot touch a single cent of your future Social Security check. This creates a massive imbalance in the theater of asset division, especially when one spouse has spent their career in the private sector, while the other worked in the public sector. Imagine a case study involving a character named Thomas and his wife, Jennifer. Thomas has spent 30 years as a high-earning corporate executive in Chicago, amassing a $1.5 million 401k. Jennifer, however, has spent 30 years as a public school teacher in a state like Ohio or Massachusetts. Because of the historical trends in certain state pension systems, Jennifer did not pay into Social Security during her career. Instead, she will receive a generous state pension. In the year 2026, Thomas and Jennifer are divorcing. Under standard equitable distribution, Thomas's $1.5 million 401k is a marital asset subject to a 50-50th split. But what about the value of Thomas's future Social Security benefits? If the court simply splits the 401k and ignores the Social Security, Thomas is left at a severe disadvantage. He loses half of his 401k, but Jennifer keeps 100% of her state pension value because of specific state laws protecting teacher retirement funds. To balance the scales, many U.S. jurisdictions utilize the Social Security offset. This is a masterclass in forensic math. The court attempts to calculate the present value of the Social Security benefits Thomas earned during the marriage. If an expert determines that Thomas's future Social Security stream is worth a present value of $400,000, the court might offset this against the 401k. Instead of splitting the $1.5 million 401k equally, the court might award Thomas $950,000 and Jennifer $550,000. This potential outcome ensures that both parties walk away with a similar total retirement floor, even though the Social Security itself remains untouched. This brings us to the most dangerous acronyms in U.S. retirement theater: WEP and GPO. The windfall elimination provision and the government pension offset are federal laws designed to prevent double-dipping by public employees. If Jennifer, the teacher, expects to collect a portion of Thomas's Social Security after their divorce, she might be in for a shocking historical trend of benefit reduction. Under the GPO, if Jennifer receives a government pension from work where she did not pay Social Security taxes, her spousal or survivor benefits from Thomas's record can be reduced by 2/3 of the amount of her own pension. In many 2026 cases, This effectively wipes out the spousal benefit entirely, leaving the ex-spouse with nothing but their own pension. Step by step, the defense against this begins with the one document you must file with the Social Security Administration before your divorce is finalized: the Request for Social Security Earnings Information, or Form SSA 7050. While many people rely on the simple annual statement, the 7050 provides a certified, year-by-year breakdown of every dollar earned and every credit accrued. In the theater of 2026 litigation, this document is the foundation of the Social Security valuation. Without it, your attorney is guessing. With it, a forensic accountant can use the Social Security Administration's specific actuarial tables to determine the exact present value of the marital portion of that benefit. But there is a specific timing rule that acts as a trapdoor in this script. To be eligible for derivative benefits on an ex-spouse record, the marriage must have lasted at least 10 consecutive years. Not 9 years and 11 months, 10 years. In the historical trends of U.S. divorce, we see a phenomenon known as the 10-year dash, where one spouse may attempt to finalize the divorce at the 9-year mark to prevent the other from ever accessing their Social Security record. If you are the spouse with fewer credits, delaying the final decree by just 30 days can be the difference between a lifetime of supplemental income and total financial reliance on a 401k that may be subject to market volatility. In 2026, the value of this derivative benefit is calculated using a complex formula involving the primary insurance amount, or PIA. If Thomas and Jennifer were married for over 10 years, Jennifer is entitled to up to 50% of Thomas's PIA once they both reach retirement age, provided she remains unmarried. This does not reduce Thomas's own benefit by a single penny. It is a phantom benefit created by the federal government. However, the theater turns into a tragedy if Jennifer remarries before age 60. The moment she says "I do" to a new partner, her right to claim on Thomas's record instantly vanishes. The only exception is if that second marriage ends in death or divorce, at which point the right to the first spouse's record can sometimes be resurrected. The math of the offset becomes even more high stakes when we look at the 2026 cost of living adjustments, or COLAs. Social Security is one of the few retirement streams in the United States that is historically indexed to inflation. A 401k is not. If the court is offsetting a 401k against a Social Security stream, the expert must account for the fact that the Social Security will likely grow every year, whereas the 401k might be depleted by a market downturn. This requires the use of a discount rate, often represented in latex as PV equals T equals 1, sigma, N, 1 plus I, T, R, T, where PV is the present value, R, T, is the expected benefit in year T, and I is the inflation-adjusted discount rate. In 2026, where inflation expectations have fluctuated wildly, choosing the wrong I value can result in an offset that is off by over $100,000. We also have to consider the hidden 401k within the Social Security system, the delayed retirement credits. If Thomas chooses to wait until age 70 to claim his benefits, his check will be approximately 76% higher than if he claimed at age 62. In a 2026 divorce negotiation, should the 401k be divided based on the value of the benefit at age 62 or age 70? The historical trend in U.S. courts is to use the full retirement age value, usually 67 for those born after 1960. However, a savvy negotiator will argue for a valuation that reflects the most likely potential outcome, creating an open loop of debate that can stall a settlement for months. This intersection of federal and state law is where the most expensive mistakes are made. Many attorneys in 2026 still treat the 401k as an isolated island, forgetting that it is part of a larger retirement continent. If the QDRO is drafted without considering the Social Security offset, one spouse may end up double covered, while the other is left with a 401k that cannot sustain their cost of living. This is why the masterclass requires a total holistic view of the marital estate. But even after the math is settled, the taxes are calculated, and the Social Security is offset, there is one final terrifying variable. What happens if the 401k plan itself fails? What if the corporate theater goes dark, and the company that holds your retirement savings disappears overnight? As we move into the final part of our deep dive, we are looking at the ultimate safety net, the Pension Benefit Guaranty Corporation, and the catastrophic failure protocols of the U.S. retirement system. And more importantly, we will reveal the final script, the precise language you must include in your divorce decree to ensure that even if your ex-spouse passes away or the market collapses, Your 401k portion remains legally untouchable. The endgame is here. To navigate the endgame of the 401k retirement theater, we must first address the nightmare scenario that keeps every matrimonial attorney awake at night: the administrative void. Imagine a character named John in the year 2026. John has reached a settlement with his ex-wife Maria, which awards her $500,000 from his 401k. The judge signs the divorce decree on June 1st. However, the Specialized Qualified Domestic Relations Order, or QDRO, is still being drafted by a third-party actuary. On June 15th, before the QDRO is even mailed to the plan administrator, John unexpectedly passes away. In the historical trends of U.S. law, this is the moment where the theater can turn into a total financial collapse for Maria. Under the federal rules of ERISA, the 401k plan is legally obligated to pay the account balance to the named beneficiary on file. If John never updated his beneficiary designation from the time they were married, or if he updated it to his new partner immediately after the separation, Maria could be legally blocked from her $500,000 share. The plan administrator will argue that without a qualified order in hand at the time of death, Maria is a legal stranger to the account. To prevent this potential outcome, the masterclass requires the inclusion of the surviving spouse protection clause in the final divorce decree. This is a specific script of legal language that states, in the event of the participant's death prior to the completion and qualification of the QDRO, the alternate payee shall be treated as the surviving spouse for the purposes of all death benefits and survivor annuities. This single sentence acts as a placeholder that binds the plan administrator to recognize Maria's interest, even if the formal QDRO hasn't been processed. Furthermore, the decree must include a provision for a nunc pro tunc order. This is a historical legal maneuver, Latin for now for then, which allows a judge in 2026 to sign a QDRO after a party has died and backdate its effectiveness to the date of the divorce decree. Without this specific step-by-step legal scaffolding, the retirement assets are vulnerable to the whims of mortality. Beyond the risk of death, we must confront the risk of market volatility during the administrative lag. It often takes 60 to 90 days for a 401k plan administrator to review and qualify a QDRO. In the high-frequency trading world of 2026, a 401k balance can swing by 10 or 20% in a single week. If Maria's share is defined in the decree as exactly $500,000, but the total account drops from $1 million to $800,000 while the paperwork is sitting on a desk, who bears the loss? Conversely, if the market surges, does Maria get a piece of the growth? Historical trends in U.S. courtrooms have shifted toward the pro rata market adjustment clause. The final script of the decree should not just state a dollar amount. It should state, the alternate payee is awarded $500,000, adjusted for market gains and losses from the valuation date of June 1, 2026, until the date of actual distribution. This ensures that Maria is treated as a true co-investor. If the market goes up, her share grows. If it goes down, she shares the burden. This prevents the account holder from being unfairly penalized, or the alternate payee from being unfairly windfall benefited by the slow speed of corporate bureaucracy. We also have to look at the catastrophic failure of the plan itself. While 401ks are held in trust and are generally protected from a company's bankruptcy, the administrative records are not. In 2026, if the company John works for collapses and the Human Resources Department vanishes, Maria's QDRO could be lost in a digital black hole. This is why the Masterclass protocol demands the filing of a joinder. A joinder is a legal action that makes the retirement plan itself a third party to the divorce. By joining the plan, the court gains direct jurisdiction over the 401k provider. If the provider attempts to move assets or ignore a decree, they can be held in contempt of court. This is the ultimate shield in the theater of corporate instability. Now, let us examine the tax optimization of the final rollover. In 2026, the IRS has strict rules regarding the movement of QDRO funds. If Maria decides to take her $500,000 and roll it into her own IRA, she must ensure the plan administrator performs a direct trustee-to-trustee transfer. If the administrator instead cuts a check to Maria, they are historically required to withhold 20% for federal taxes. On a $500,000 award, that is $100,000 sent to the IRS. While Maria can get that money back as a refund if she deposits the full amount into an IRA within 60 days, she would have to come up with $100,000 of her own cash to bridge the gap. This is the 60-day trap that has ruined many post-divorce financial plans. The The step-by-step instruction in the divorce decree must explicitly forbid the issuance of a check in the alternate payee's name, and instead mandate a direct rollover. The final script also requires the anti-segregation clause. Some 401k plans in 2026 will attempt to charge the divorcing couple an administrative fee for processing the QDRO, sometimes ranging from $500 to $3,000. The decree must specify who pays this fee. Historically, it is split 50-50, but if one spouse was the primary cause of legal delays, a judge may order them to bear the full cost. Furthermore, the decree should specify that the account holder is prohibited from taking any further loans or hardship withdrawals from the account until the QDRO is finalized. We have seen case studies where a spouse, sensing the end is near, takes a maximum $50,000 loan the day before the QDRO is served, effectively stealing the alternate payee's share before the plan can freeze the assets. As we reach the final stage of this masterclass, we must recognize that the 401k divorce is not an event, but a process. It begins with the first contribution to the plan and ends only when the final dollar is moved into the alternate payee's account. We have covered the ERISA foundations of 1974, the QDRO breakthroughs of 1984, the tax-affected valuations of 2026, and the digital forensic hunt for blockchain-based retirement assets. You now understand the coverture fraction, the tracing method, the NUA tax strategy, and the Social Security offset. This is the complete theater of American retirement litigation. But while you have mastered the 401k, a new and even more complex stage is being built. In the evolving landscape of 2026, the definition of retirement is shifting toward the gig economy and the rise of the individual professional corporation. What happens when your retirement is not held in a 401k, but in the equity of a personal brand or a portfolio of intellectual property royalties? How do you apply the coverture fraction to a viral content library that continues to generate revenue for decades? And most importantly, how do you protect the future income of an AI-driven business model that didn't even exist when you got married? The credits are rolling on the 401k saga, but the theater of American wealth is only getting started. As you walk away from this deep dive, you are equipped with the knowledge to identify the hidden stages, the shadow assets, and the administrative traps that claim the savings of the unprepared. The final question remains. In the world of 2026, where wealth is increasingly intangible and global, is a 401k even enough to sustain the life you have scripted for yourself? We are moving from the history of retirement into the future of asset autonomy. The next series begins with the secrets of the family limited partnership and the high-stakes world of the dynasty trust. Are you ready for the next act?